Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 38 on December 1st, 2018. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Foot Locker, Wells Fargo, and Facebook. And then we're going to discuss three new trades on Urban Outfitters, Best Buy, and the E&P Oil and Gas Services ETF. Now, it's always great to hear from listeners. And if you have any questions about the trades presented here or about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need in order to be able to understand the trades that we present on this show. So you can visit our website and click on the videos tab to watch those videos, or you can find all of them on our YouTube channel for the Weekly Option. Now, this week I received an amazing response from the Black Friday offer I had last week, and we'll be following up with everyone who reached out shortly, including the winner of the book that I mentioned. So I will contact you specifically. I'm not going to say your name on air since I didn't get your permission first, but I'll be reaching out and asking for your mailing address so I can send you the book. And everyone that emailed will also receive the trading tool that I mentioned as well. So I really appreciate the response. It's always great to know who's out there listening. And one listener in particular gave me some great feedback. I really do appreciate it. Asked for a longer show with more explanations, and it's great advice and great encouragement as well. When you're recording a show, on your own, I know that people listen. I can track exactly how many listens I get each week, but I don't know how to make the show better without your feedback. So if there's anything you guys would like to add or take away from the show, let me know, and I'll try to add some of those features and make sure that you're also getting the listener experience that you really want, because I definitely want you to enjoy the show. Otherwise, I wouldn't take the time to record it each week. And one of the things that I'm adding, and I'll start today, is a new segment called the Topic of the Week. So we'll have that each week's show. So if there are any specific topics that you'd like to discuss, or even types of trade that you want to learn more about, just send me an email. Again, my email is eric@theweeklyoption.com, and that's ERIC. And, if it fits in the show, or if it's a topic that I'd like to cover as well, I definitely will add it to the show. There are a couple things that I'll try to avoid on the show, like if you really want to get into the more technical sides of option trading, covering things like kurtosis and skew and whatnot. I don't want to, my goal here is to make option trading easier. And there are some complicated topics that I'm happy to discuss in an email, but I might not want to put them on a broadcast, on an actual podcast, just because my goal is not to confuse people. So, option trading can be as complex or as sort of simple as you like. And my goal on the show is certainly to err on the less complex topics so that it can be digestible for a larger group, a larger audience. So that's it. Let's see, in the markets this week, the equity markets finished the week stronger, with the S&P 500 leading the charge. The S&P 500 index was up 127 points this week, nearly 5% over the week, finishing at 2,760 points. Of course, that really just offsets the significant drop that we saw last week. I think if you look at the change in the last 2 weeks, it's maybe 40 points. Now, the Dow Jones Industrial Average rose 252 points this week, ending the week at 25,538 points. That's nearly 1% move week over week for the Dow. Now, this upcoming week, there are 99 publicly traded companies here in the U.S. that will be announcing their earnings. On Tuesday, we'll hear earnings from Toll Brothers and Dollar General. On Wednesday, we'll hear from a handful of retailers. We'll have American Eagle, Lululemon, and Lands' End. And then also H&R Block will be announcing their quarterly earnings. And then on Thursday, we hear from Kroger. And on Friday, Vail Resorts. And I only mention Vail because my mind has been on skiing. I'm looking forward to ski season starting. I have a good buddy of mine that actually skied Vail and Beaver Creek over Thanksgiving. So I certainly have the itch to get started skiing. I don't know if any of you guys ski, but I do have a season pass, the Epic Pass from Vail. This is not a plug for them by any means because they only receive my money. They aren't paying me any. But it's something I enjoy, and if you guys enjoy it too, maybe we'll meet on the mountains at some point, and you can watch me attempt to take on some of these more challenging hills. So let's dive into the new segment, the topic of the week. So this week I figured I would discuss spread trading, and spread trading is one of those things that I think defines my trading style. There are a lot of different trading styles out there. You have guys that just look to put on massive positions that are going to focus on one side of the market. Like, I'm going to bet all of my money that crude oil will go up or go down. And that's never really been my style for my own portfolio or even when I trade professionally for companies. So I like spread trading, and I'll start off just by explaining it. So spread trading, a spread is when you buy and sell something. The difference in price is what creates the actual spread, right? So with options, 2/3 of the trades that I mention on the show, the credit spread and the debit spread obviously have that word spread in it. And that's because I'm buying one option and selling a different option. And that creates a scenario that I really like. So right off the bat, you have defined risk. I know my maximum upside and downside. So from the start, I know how much money that I could possibly make from this trade. And I also know how much I could possibly lose. And the reason that is important is because it helps me put on the right amount of risk for the trades. It helps me to size my trade. So let's say I'm looking at a trade, and I've got let's say you're trading a $10,000 account, and you figure you can risk 10% on a covered call trade, or you're willing to risk, let's say you risk 5% on any single trade during the month. So 5% of that $10,000 is $500. And let's say that I say right off the bat that I'm looking at a trade that could lose 33 cents or $33 per spread. If I'm only willing to risk $500, then I'm going to take that $500 total risk, which would be 5% of my smaller options account, and then I'm going to take the maximum risk, not the most that I could make, but the amount of risk that I'm willing to put on, and divide that into my position size. So I'm going to divide that $500 by 33, right? That's going to give me like 13. I don't know. I'm just doing the math off of my head, but that'll let me know how many spreads I could possibly enter and still maintain the appropriate amount of risk for my portfolio, right? So you always, in trading, the way I look at trading, I always am hoping to reach my maximum goal, reach my maximum amount, but I have to plan for loss. And specifically in trading, the guys who have a career in trading, a successful one at least, tend to know how to manage their risk. Part of that is sizing your trade appropriately. And so for me, by trading spreads right off the bat, I know that I know what my maximum risk is. And if I say, okay, I'm only willing to risk $500 on this specific trade, that lets me know the maximum number of spreads that I'm willing to put on. So I'm never just like, hey, I'm willing to risk X amount of capital and I'm hoping that I don't lose it all. It's like, no, I'm going to manage both the upside and the downside. And in that scenario, of, say, a 33-cent risk, that means that I would have collected 17 cents on that spread, most likely a 50-cent kind of spread. And that means that if I trade 13 of them and I've got 17 cents on the line, 17 bucks on the line, that lets me know also what my maximum amount, my maximum gain is going to be, right? It'd be 13, the number of spreads that I'm putting on, times 17. So that's it. That's one of the ways I look at it. But I'm never about betting the house. I never bet the house. I'm looking at hitting singles and doubles consistently, so that no single trade ever takes me out of the market. And month in, month out, I'm adding money. My account is growing. So, hitting singles and doubles. And the funny thing about hitting singles and doubles is that you get up to bat, just to continue this baseball analogy, which I'm sure is making a couple of your eyes roll. Forgive me for this period, but the baseball analogy, is that at some point you're going to see the perfect pitch and you're going to put everything you have behind it. And the scenario in trading is you'll see the perfect market set up and you'll say, you know what, I normally risk 5% on a trade, but on this one, I'm going to risk 20%. Or maybe I just risk 10%, whatever it is that's appropriate for your risk tolerance. And you take a bigger swing, hoping for a bigger return because you've been to bat several times already. You have an idea of what market setups work best for your personality, right? And that's the other part of this whole trading thing, is that all of us have different personalities, and that's going to come through. It's going to play out in your trading style. So I could tell you, like each week I tell you on the show, I give you, stock price and then a handful of trades that I'm either looking at or already in. And the challenge there is that I'm going to manage that trade differently than you will because my personality and my background and all the intangible things like experience, like size of account, all of that is a factor in how we all manage our trading. So no two traders are going to be alike, even if we enter the trade at the same price. Something subtle to think about. And that's why on this show, I really enjoy walking you through trading. And I use end of day Friday prices, not, opening prices on Monday morning, because inevitably by the time I put this podcast out there and each of you have a second to listen to it, the market moves. So you'll never get the exact same price that I got, right? Or if you do, you really have to look at that market and say, okay, is this really a trade that I want to be in? But the good thing about the way I trade as well is that like some people look for mispricings in the market. Just by my very nature, I'm assuming that the market is priced for a reason. It's priced a particular way for a reason. So oftentimes you can look at option prices both on the put and the call side and say, okay, I get it. The specialist or the market really is pricing these call spreads a lot more expensively than the put spreads. That tells me that they're expecting prices to go up, and they're really not they're not going to sell you that risk or allow you to sell them that risk for cheap. Like it's going to be expensive, and that means that sort of gives me an idea of where they're expecting the market to go just by how they're leaning their price. So that's it for this opening segment. Again, if there are other questions or topics you'd like to cover, I have a whole slew that I'll cover over the next weeks, but I'm happy and actually want to hear back from the listeners so that I'm giving you the kind of show that you want. So let's start off by looking at this week's trades. And I'll tell you, this week was not the best for me, but we'll get into that. So we'll start off with Foot Locker, our covered call. Last week we looked at Foot Locker, the symbol FL, Foot Locker. The stock symbol, or the stock price when we looked at it, was $52.96. We looked at buying stock and selling that December 55 call at $1.40. Hoping to yield a 6.5% return in 4 weeks. Now, Foot Locker stock rose $3.44 this week, ending the week at $56.40. So this stock clearly did a little better than I expected. way sooner than expected. So with 3 weeks left in this trade, we have a few decisions we need to make. First off, you can let it ride, knowing that with stock above $55 per share, you've made your 6.5% return for the month, right? Plan B, of course, is to get active. That would involve paying $2.80 to buy back this call, assuming you haven't been assigned on it yet. So if you still have that call in your portfolio, you can buy it back. That would result in a $1.40 loss on the option itself, but you get to keep the gain on the stock, the $3.44 gain in the stock. So that means a net profit of $2.04 per share in a week. That's really good. Now, your final option is to do something a little bit different. You could buy that call back and then sell out a further strike. So maybe look at selling the December 60 call for 60 cents. This would keep the stock in your portfolio, right? So you'd still own that stock, because you'd essentially be locking in a gain of $2.64 today on the stock, and with another possible $3.60 to be gained in the stock if it continues running higher and finishes higher than $60 per share. So, the covered calls are great when it all works. The main thing to watch for is downside move in the stock. If the stock moves down, that's going to obviously hurt you, because your biggest gain right now is coming from the stock and not from the option premium that you're collecting. So remember, in the cover call, your largest risk is that down move in the stock, and you have the shares to deliver against the option. So a big up move in the stock is not really a concern. In fact, it's what we want. The long stock position is what creates the risk in this trade. Now, our second trade last week was on Wells Fargo. It was a credit spread. Wells Fargo is symbol WFC, William Frank Charlie. The stock ended the week at $51.83. And we looked at selling the December 52.5 53 call spread, collecting 18 cents, and looking at a maximum loss of 32 cents on this spread. So the Wells Fargo stock rose $2.45 this week, ending the week at $54.28. Now, since we sold a call spread for 18 cents and have a maximum loss of 32 cents in this trade, we lost essentially a good chunk of that money. Given the fact that we sold that call spread and stock climbed much higher, we lost money on the spread. So the spread is currently valuing at 47 cents, which means we would be locking in a 29 cents loss out of a maximum 32 cents loss, which was the maximum loss from the start. So we knew at the start we could lose 32 cents. So far, given the pricing in the market, we've lost 29 cents of that. I actually don't think it's worth buying back in this option spread to save 3 cents. You could look at selling the December 53 52.5 put spread against this trade. It basically lowers your total loss by the 11 cents that you collect, but you're then basically guaranteeing a loss of 21 cents on the spread on the trade overall, which is, I guess 30% better than the full-on 32-cent loss. So something to think about, but this spread is actually losing at this point. I'll probably give it a few more days to decide fully if I'm just going to let it expire and take the full loss, or if I'm going to make a move to try and sell something against it and at least bring in some money that will, like if I sell this put spread, it actually lowers the amount of money that I've lost on this trade. So bringing in a little bit more money will help cushion or help me move away from my maximum loss. Next up, we're looking at the debit spread last week, and unfortunately, this also is going to be a loss too. I'm telling you, this week I took it on the chin on both, but again, I trade spreads, so I know my maximum loss right up front, and sometimes you get it, and then you get to make a second decision to try to limit that loss. So Facebook, symbol FB, Frank Berry, stock last week was $131.73. And I looked at buying the Dees 133-132 put spread, and in the money put spread, and paying 60 cents which leads to a maximum gain of 40 cents or 66% return in 4 weeks. Well, the stock rose $8.88 this week, ending the week at $140.61. That in-the-money put spread we purchased is now significantly out of the money and only worth 15 cents. We lost money on this spread since we paid 60 cents on the trade. Net, we've lost 45 cents so far on this spread. Our maximum loss was 60 cents, the amount of money that we paid on the spread going in. So we've assumed or have already experienced 75% of our loss, or our investment lost. Our investment cost is gone. Now, you have the option of selling a call spread against this trade as well to try to recapture some money, or even just consider selling another put spread on the downside. My issue is that the stock hasn't really broken out of its downward trend, so I haven't given up on this trade. If you look at stock on Facebook, it's been on a downward move or downward trend for a little while, and I kind of look at this as one of those things where sometimes, being patient is being prudent. It's the most prudent thing you can do. So I'm going to wait a few more days to see what this stock does before making any defensive moves. We're still, of course, 3 weeks away from expiration. And the moment this stock starts to look like it's heading down again, I'm going to be high-fiving myself because I want this spread to finish back in the money. And I think it's still well within its trend range for it to do it. Now let's look at the spreads for this week, or the trades for this week. We, of course, always start off with a covered call. So this week we're starting off with Urban Outfitters, symbol URBN, Uncle Richard Brian Nancy. Stock ended the week at $38.09. I'm looking at selling the December 39 call for $1.05, which ultimately will yield a 5% return in 3 weeks. Now, we'd enter this trade by buying stock. If you're not already long it, you would buy stock for $38.09, and you're going to sell that December 39 call for $1.05. This trade makes the most money if stock prices rise above $39 a share. Now, this stock announced earnings a few weeks ago, 2 weeks ago actually. And so with this sort of retail good, I actually am expecting a little bit of a bump, or at least for prices to stay where they are, go a little bit higher over the next few weeks. So I like this trade. I like owning the stock. I like selling the call against it. So we'll see if we can make a 5% return here in the month of December. And of course, December expiration is going to be on December 21st, the Friday right before Christmas. So that'll be options expiration. So hopefully this will be a nice little Christmas gift for us, all of these December trades. Now, our second spread for the week, our second trade is going to be a credit spread on Best Buy, symbol BBY, Brian Yellow. Stock ended the week at $64.59. And I'm looking at selling the December 65 half call spread. It's an out-of-the-money spread, collecting 15 cents. This creates a maximum loss scenario of 35 cents. And my break-even point is going to be $65.15 in the stock. Now, I would enter this trade by selling the December 65 call and collecting $1.85 for that, and then buying the December 65.50 call for $1.70. This is a credit spread because we are selling the spread, and this trade makes money if stock prices stay, it makes the most money actually, if stock prices stay below $65 per share. Now, this stock has been in a bearish price trend since late August. It's moved down significantly. Any temporary or momentary rises in price have failed to alter that trend. And I don't expect this to change over the coming weeks, even with it being Christmas time and the possibility of people shopping for electronics. I'm expecting this stock price to either stay around where it is or head lower. So I'm happy selling this call spread for 15 cents. And then our final trade for the week is our debit spread. And I reverted back to an ETF. I love ETFs. I've mentioned that on the show before, exchange traded funds. We're looking at the E&P, which stands for exploration and production. So E&P, oil and gas services ETF, symbol is XOP, X-Ray Oscar Paul. The stock or the ETF finished the week at $32.81. And I'm looking at buying the December 34.33 put spread, paying 33 cents on it. This is a 50-cent wide put spread. So our maximum gain, of course, is 17 cents. And that's a 51% return on our investment in 3 weeks. Now, you enter this trade by buying the December 34 put for $2.16. And then you would sell the December 33.50 put spread. I'm sorry, the December 33.50 put at $1.83. This is a debit spread because we are paying for the spread. We're paying 33 cents on the spread. And this trade makes the most money if stock prices stay below $33.50. We have a break-even price on the trade of $33.67. So as long as we stay below that price, we'll be doing pretty good financially on this trade. So there's been a lot of pressure on crude oil prices lately, and in fact, crude oil finished the week at one of its lows, $51 a barrel. And so this sector is bound to be hurt by lower oil prices. So I feel good buying a put spread, which will only benefit if crude oil prices stay low, and hence this ETF stays low in price as well. Now that's it for the show for the week. Thank you guys so much for listening. Please do reach out to me at eric@theweeklyoption.com. Let me know what you think. If you want anything to change on the show, or if you want me to, let me know. I'm really open to suggestion. I appreciate your ears and your weekly listening. And also, I've got a free trading tool I'm going to be emailing out to the people that reached out last week, but definitely would love to share that with more people. It's something that I use to help me visualize and better understand any option position that I'm considering entering. And it makes understanding where you make money and where you lose money significantly better. So feel free to email me, or you can even reach out through the contact page on the website, theweeklyoption.com. That's it. Have a great week. Happy trading. Bye-bye. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.